Amazon stock has gone from under $16 to over $180 in the last 10 years. That's an 11x return, and it's up 80% in the last year. It is one of the largest companies in the world with a market cap approaching $2 trillion, and it is making a massive push into AI with a focus on generative AI and leveraging its rapidly growing cloud business, AWS. So is now the time to buy this tech juggernaut? Tune in and find out. Okay, 3 things that we're going to cover in this video. Number 1, the business model. So they have 4 components: advertising and subscription, AWS, third-party sellers, online and physical stores. Number 2, the future. CEO Andy Jassy released his annual letter to shareholders. I've pulled out the juicy parts just for you. And number 3, the valuation. Wall Street has Amazon at an average value of $210 per share, which is a 15% discount. On Wall Street, we build 3-statement financial models, culminating in a DCF or discounted cash flow valuation. I have built a 3-statement model. I think Amazon is fairly valued at current levels, and I can't wait to give you all the details. So let's dive right in. Okay, first piece that we're covering, the business model. So there's 4 components to Amazon's business: advertising and subscription. That's 15% of revenues. It was 6% of revenues 5 years ago. It's achieved 6.1x growth. These are things like product sales, digital media content, online and in stores. Think Prime Video. Number 2, AWS. That's 16% of the business. It was 11% of the business 5 years ago. That's had 3.5x growth. Think Amazon Web Services, the clouds, things like storage and applications. Number 3, third-party sellers. That's 24% of the business. It was 18% 5 years ago. 3.3x growth. Think of sellers who use Amazon, like Amazon FBA. And number 4, online and physical stores. Today, that's 44% of the business. 5 years ago, it was 60% of the business, and it's almost doubled over the last 5 years. Think of Whole Foods, Amazon physical stores, and Amazon online. So what's the takeaway? Amazon's business model is shifting from physical goods to services. Okay, second thing we're covering in the video, the future. CEO Andy Jassy released his annual letter to shareholders. I pulled out some juicy bits for us. So first, Amazon sees generative AI powering future breakthroughs. Think of chatbots. They have a $4 billion investment in Anthropic, an AI startup, and they're building their own AI models. Really cool stuff. Also, the company plans to do more in building AI chips. They want to be less dependent on NVIDIA. They've already built chips that are being used by Airbnb, Snap, and others. Amazon SageMaker is a service that helps companies organize their data so that it's AI ready. Number 3, Amazon's dominant cloud business gives it an edge. AWS customers are turning to Amazon to build and scale their AI applications. Amazon's building AI apps across all of its businesses and leveraging development partners as well. Next, Prime Video could be a profit machine. They have 200 million monthly viewers. They recently introduced advertising, and you've probably seen Thursday Night Football, maybe some of your local sports. I'm a Yankees fan. I've seen them on there as well. Lastly, crazy stuff. Space could be the next frontier. Project Kuiper, its satellite internet business, they launched 2 prototypes into space to provide broadband access to remote areas. What does that sound like? Low Earth satellite business to compete with Elon Musk's Starlink. But Amazon sees room for growth there. Its first production satellites are set for launch later this year. So what's the takeaway? They're massively leveraging and investing in AI. They're developing their own AI chips, and they're leveraging AWS with AI. Also, streaming with Prime Video, and they're planning on competing with Starlink. So a lot of cool stuff there. If you're enjoying this, please smash that like button. All right, so the third part of our video, getting into the valuation, starting with the balance sheet. So key points here, the company has tons of cash, almost $90 billion. It's 2x in the last 5 years. Now, while debt has also doubled in the last 5 years, they have very low leverage. Debt is only 3% of the total capital, and they've been net cash the last 7 years. That means their cash is greater than their debt. Also, they control 650,000 square feet of real estate, up from 290,000 5 years ago. And they have a 6 times increase in retained earnings over the last 5 years. They're investing very heavily in fulfillment and the cloud, which we're going to see next in the income statement. So what is the takeaway from the balance sheet? They're very conservatively financed. They're net cash. They have a solid balance sheet with a AA credit rating. Let's hop into the model. All right, so a few things to note in our financial model here. You look at the cash, it was about $55 billion in 2019. Today, it's about $90 billion, very close. Now, although they've had a nice increase in their cash, they've also had an increase in debt. We don't really care, though, because as I mentioned, they're net cash. Another thing, we see that retained earnings just has absolutely exploded, going from 31 to 113 billion over the last 5 years. Truly remarkable. They're growing very, very quickly. Okay, next financial statement, income statement. So revenue has grown 2.5 times in the last 5 years, while net income has grown 3 times. What does this mean? Phenomenal cost control, positive operating leverage. They have almost 600 billion in revenues. Their gross margin is up 10%, and their net margin has tripled over the last 7 years. What does this mean? Incredible cost control. Remember, revenue is what you make, net income is what you keep. They made big investments in fulfillment, technology, and infrastructure, 130 billion in 2023. Also, one thing to note, they were hammered by their investment in Rivian in 2022, which was an equity investment that lost $12.7 billion. Now, we are going to see they're reinvesting in their business. We're going to notice this later on in the cash flow statement. So what's the takeaway here? The company's growing responsibly with revenue growth outpacing costs, which means positive operating leverage. Their 5-year average return on invested capital is 12%. Their 5-year return on equity is 16%. So they have really solid returns. Let's dive in the model. Okay, so a few key takeaways here. Their 5-year revenue growth is 2.5x. Unbelievable. Also, fulfillment, technology, infrastructure, they're investing heavily into their data centers and their fulfillment centers, 130 billion in 2023. You'll notice right here, this massive outflow, 12.7 of which was from the Rivian debacle. But also you can see their 5-year growth in net income, 3x. So their net income is growing at a faster pace than their revenue. Remember, revenue is what you make, net income is what you keep. All right, next statement to talk about, the cash flow statement. So free cash flow has nearly doubled in the last 5 years, while operating cash flow has nearly tripled. Also, unlike other tech companies, they're reinvesting more in their business. They've invested $255 billion over the last 5 years in acquisitions and capital expenditures. Rather than returning money to shareholders, they're investing more into the company. This is something I like to see. Also, they're making tons of money off of their cash with $170 billion of positive cash flow over the last 5 years. So what's the takeaway? Cash is going to 3x by 2028 if the 5-year average trend continues, and they're projected to invest over $400 billion in capital expenditures over the next 5 years. Let's hop in the model. All right, so the cash flow statement. We see that they've had a nice growth in free cash flow over the last several years. Also, I mentioned massive investment in capital expenditures. They've invested $234 billion over the last 5 years. You can also see that they've made a ton of money on their invested cash, $170 billion over the last 5 years. And something that we don't see with a lot of other tech companies, they're not returning a ton to shareholders. They're reinvesting it in the business. So they don't pay a dividend, and we see only $6 billion of share repurchases over the last 5 years. This is very different from the Apples and the Microsofts of the world. If you're finding this helpful, please hit that like button. Okay, next we're going to cover forecast drivers and DCF assumptions. So the company's shown incredible cost control with high revenue growth. Their cost of goods sold and overhead went from 61% to 54% of their total revenue. So they've shaved off 6%. That's about $35 billion of cost savings. Truly remarkable. Also, 132 billion of debt has been repaid over the last 5 years, with another 28 billion coming over the next 5 years. They have a moderate beta for a tech firm, only 1.2, which results in a moderate WACC, about 9.5% in their case. They have low leverage, only 3% of their capital structure is debt, and a AA credit rating. So what is the takeaway here? Conservative assumptions are going to give us conservative results. Okay, so big takeaway here with the forecast drivers. They've had massive revenue growth, double-digit percentages over a very long time. But if you look at their costs, they've been very, very calculated and very conservative with their cost structure. So their cost of goods sold, basically what they're paying for goods that they ultimately resell, has gone down significantly. Also, G&A overhead has definitely not grown over time. They've kept a lid on it, which is great. So now going into the DCF assumptions, you see that we build off 3 different cases here. We have a bear, a bull, and a base case. As I mentioned previously, the beta 1.2, that's actually very reasonable for a tech company. We have the 5-year risk-free rate, 4.68. Beta market risk premium, we get a cost of equity of 9.64. They have a AA credit rating, which corresponds to a pre-tax cost of debt of 5.38%. We end up getting a post-tax cost of debt of 4.25. I mentioned very low leverage, only 3%. So we end up getting a WACC of about 9.5%. Current share price, 183.32. The market cap, 1.9 trillion. Total capital, 1.96 trillion. And look, they have almost $90 billion in cash sitting there. Truly remarkable. Now, don't forget, at the end of our financial model, we're going to have a terminal value. This is going to be 20 times EBITDA. This is very important because it's the value from the end of the model out into infinity. All right, next we come to the DCF valuation. So we ran 3 scenarios: a bear case or downside, base case, steady state, and bull case, which is an upside. The current model is set to the base case. Now, you'll notice, very high growth company. They have lots of cash, big investments, a huge push into AI, but is it worth buying today? The stock is up over 80% the last year. And remember, Wall Street has Amazon at an average of $210 per share, which is about 15% upside. Let's dive in the model. All right, standard DCF here. We have EBITDA minus DNA gives us EBIT less cash taxes. We get EBIT or NOPAT. We add back DNA. We have the changes in operating working capital, CapEx. We get free cash flow to the firm. Remember the terminal value? That's 20 times the terminal EBITDA. We end up taking all of those cash flows. We discount them back to today by the discount factor to get the present value of each of those respective cash flows, which leads to a total enterprise value of about $1.8 trillion. We strip out the debt, we add the cash, strip out non-controlling interest, add associate investments. We get $1.8 trillion for the intrinsic equity value. We divide that by the shares outstanding. That gives us a value, an intrinsic value per share of about 175 bucks. The current share price is about 183. So that means it's a 4.3% premium, which is a sell. We don't want to buy something for more than we think it's worth. All right, as we always do, we've run a sensitivity and scenario analysis. So we ran 50 different models by utilizing data tables. We sensitized revenue growth and CapEx intensity, as well as weighted average cost of capital and terminal multiples. We ended up getting 70% of the time it was a sell, 30% of the time it was a hold, and 0% of the time was it a buy. So we ran each of the scenarios equally weighted. We got a weighted average value of about $180, which is about a 2% premium. So ultimately, what is the takeaway? Utilizing conservative assumptions, we show a sell rating for the stock. It's at a slight premium. So as I mentioned a moment ago, we have our sensitivity analysis. We did CapEx intensity and revenue growth. The bulk of the time, red, we get sell. And same thing down here when we did WACC and the terminal multiple. So we get 70% of the time it's sell, 30% of the time it's hold, 0% of the time is it a buy. Next, we come to our scenario analysis. So we equally weighted the bear, bull, and base case scenarios. We ended up getting a sell in 2 out of the 3 scenarios, a buy in the bull scenario. Ultimately, the weighted average works out to about $180, which is about a 2% premium. We don't want to overpay for something, so that works out to be a sell. All right, so here's the wrap up. Wall Street has Amazon at an average of $210, which is about a 15% discount, with a high of $235, which is 28% upside, and a low of $150, which is 18% downside. So our analysis showed Amazon at a value of about 175 bucks, which is a 4% premium. This is not something that we would buy currently. You should seek the advice of an investment professional always. I do not have a position in Amazon, but if it got down to the 140s, a nice little pullback, I'd be very interested in including it in my portfolio. The valuation's a little frothy right now, but be on the lookout for pullbacks. With almost $90 billion in cash, a AA credit rating, hundreds of billions of CapEx planned, Amazon has huge plans for AI. I'm excited to see what they do. If you like this and want to see another tech valuation, check out my Apple model here or my Microsoft model here. And if you find this valuable, please share this with someone who you think would enjoy this. Be relentless.